evening to everyone. Absolute pleasure. We're bringing you back the Multimillionaire Forum in its next episode. As you know, for the people who've been following the Multimillionaire Forum, this is something that we do regularly. Once upon a time, this Multimillionaire Forum was a program which was purely by invitation. Now, thanks to COVID, this has become like an open for all kind of a thing, and we are getting an opportunity to share some of the most beautiful, some of the most lovely curated investment ideas that we bring to you. And we bring to you this thing month after month, sometimes twice a month, depending on the availability of our guests and speakers also. And again, Multimillionaire Forum, it's a place where we believe that, this is one area where you could come, you could join, you could participate, you can post your questions. We're doing this thing on Facebook Live, so just feel free to put in your questions there as we sort of move along the next 30 or 40 minutes. We all know that great returns happen, when you take great investment decisions, and Multimillionaire Forum is just one of those places where you might just get this opportunity, and something might happen. It might ring a bell to you. You might feel, motivated to do something that you've never done before. You might find out a new idea for yourself, something that you were looking forward to, or we will try and help you with one of such ideas. So that's why the Multimillionaire Forum is here for you. Today, my guest is my friend Raj Mehta. Raj Mehta is a fund manager at Parag Parikh Mutual Fund. Now, Parag Parikh Mutual Fund has the name of its founder, Parag Parikh. Parag Bhai, late Parag Bhai, I should say, was one of the most savvy investors who followed and believed the principle of value investing, which is a science of investing which believes that, let us buy shares which are absolutely at a fair price, not at a fantastic price. So you might have a great company which is at a fantastic price, but that does not make it a great investment decision at that point in time. You have to wait for that fantastic company to come to you at a fantastic price also. And that's what value investing is all about. He's written a lot in the subject of behavioral investing as well. So that's a little introduction on late Parag Parikh. I completely admire the person. I met him in person many years ago, of course, while he was there, and unfortunately he passed away in a car accident a few years ago in America. So having said that, that's about Parag Parikh Mutual Fund, a very unique and a very different mutual fund who's come to the Indian market with one equity fund, just one, okay, versus the 30 or 40 different funds that we have. And we're going to talk about one of their funds, which is the long-term equity fund. And within that, we have a very interesting theme that we are going to talk about. And that theme that we're going to talk about is the theme of international investing. Why should we invest internationally? What's wrong, for example, with India? Now, that's the first question that comes to the mind of most of us when we talk about investing internationally. So we think on one side that the Indian investment market is so robust. India is on a growth pace, despite the COVID-19 situation that we are faced with, and the fact that our GDP is going to fall down. We are not going to progress as much as we were thinking we would progress, and things like that. But despite that, the $5 trillion economy is pretty much on its way. It's not gone away anywhere else. So in the light of this background, why are we even talking about, or why are we even thinking about international funds? Now, I want to show you a handful of things first so that you get a sense of why is this international investing a very interesting idea and which we must consider. Okay, so here is something for you to chew on. Now this is a little information and data point which I collected from another presentation, and the sources from Axis and a couple of other places. So what this slide particularly tells you is that in America, which is typically 41% of the world market capitalization, that is to say that in the entire world, the total investments out of that 41% happens in America. And within America, the American people invest about 80% of their money in their own country. Compared to that, in India, almost all of us, which is 99.8%, or let's say that's almost 100%, we invest our money in India. Why? Because we have familiarity, we think we know India, we think we understand the Indian business, so on and so forth. And lots of other reasons, comfort factor, the fact that we are here, the fact that we are Indians, we are familiar, and India is on a growth path, so why don't we just invest in India and forget about investing anywhere else in the world? So that's one statistic to see that we as Indians don't normally go. And most of the times we are talking in terms of the return that we can get from India. So if we get fabulous return in India, why should we really go outside India? Now, let me show you another picture here. Okay. Now, this is a little bit of a complex slide. There's a lot of action happening on this slide. But what this basically tells you is that this is an analysis from 2010, which is the last 10 years. The topmost row that you see here are the countries that had the highest return in that particular year. And of course, this is in US dollar terms. So as you can see, popular to the general belief, that the Indian market is obviously going to do very well. So contrary to that, you can see that the US market was the best performer in 2011 and 2013 and 2018. And having said that, India was the top performer in dollar terms in 2012. And Japan was likewise the highest performer in 2015. So this is an analysis of the yearly data. And as you can see, these little light green patches, India. So India is not really on the top row all the time. It's entered about 2 times as the second highest, about 2 times as the third highest, and India is basically all over the place, which means that Indian market has not been the top performing markets in all the 10 years of the last decade. And you've got the US market, which is far more outperformed because it's the largest market of the world, that has outperformed. And not only that, there are companies from various parts of the world which are also doing some great business. And if we have a vehicle and an opportunity to invest in some of these, why not actually think about it? Why not actually consider it? So that's that's the background. That's the case that I really wanted to talk to you about. But why international investing? Now, I want to present to you yet another perspective before I bring Raj in. Think about it in dollar terms. Okay. Today, in the Indian market, on the Nifty, we are at about 13,000. In 2008, which is the time where we had the last major rally and then the major fall, at that time, the Nifty was around 6,250, say 6,500, just for simplicity's sake. So we have sort of doubled. It's been 12 years. So from 6,500, we are at 13,000 now. We are double. However, the US dollar's exchange rate to the Indian rupee in 2008 was about 40 rupees. And today we're close to about 75 odd rupees. Now think about it in that fashion, that in a 12-year period, if you were a dollar investor, if you were a foreign institutional investor or a foreign investor who came to India and looked at India as an option, then in 12 years time, purely on the index, you have moved somewhere from 6,500 to just about 6,500, 6,700. Because if you sort of divide 13,000 of the Nifty by 2, which is the doubling of the US dollar, then you will see that we have been pretty much at the same level. So a dollar investor may not have made as much as money as much as maybe a Indian rupee investor would have. Of course, there are companies, which have far outperformed this kind of a statistic. But having said that, it's just a perspective for us to understand what is exactly happening from a US dollar perspective, and why we should also have some US dollars in our portfolio. So with that, Raj, I want to bring you in, having said that, so India, we know, is going to become like a $5 trillion economy. We've been talking it, and it may happen in the next 5 years, may happen in the next 10 years. This is what we're told. We already know that we are the fifth or the sixth largest economy in the world. And you see, India obviously is going to grow faster than the other parts of the world. So whether it's India, China somewhere is facing a little bit of a backlash at the moment, but there was a time BRIC nations and India specifically was obviously going to grow faster, which is also what is happening. It's not, the fact is not taken away. But then in the light of this and some of the things I said, why do you feel from a Parag Parikh mutual fund point of view that we should really consider investing internationally abroad out of India? And what would be the fundamental principle or the logic or the reasoning why we as Indian investors, we should consider international investing?
Firstly, thank you, Kartik, for that introduction of our founder and the firm. And thank you, Team Transit, for organizing the Multimillionaire Forum and having me here. So, on international investing, the background that you have given. So, as you said, India is just 3% of the world's market cap. So, there are a lot of opportunities which are available globally, which are not available in India. Plus, what happens is if you diversify globally, you reduce the country risk. So, you're not present in one country, you reduce the country risk, and then there are always some times when some markets will do well, other times when other markets will do well. So winners will keep rotating, and the point is to have diversification so that you reduce the volatility in your portfolio returns. So that's the main thesis that we have. Why our Parag Parikh long-term equity fund, which is the flagship scheme, invests globally, and that gives the option to the investors to diversify globally. So since this is an Indian mutual fund which invests abroad, this will not give you a dollar exposure, as you said. If you want a dollar exposure, you may have to go through the LRS route where you remit dollars outside and then you invest abroad. But if you want to invest in Indian rupees at the same time invest globally, then this is a good option.
Thank you, Raj. Thank you for that. Little, setting the ball rolling, so to say. So like you said, Parag Parikh is a multi-cap fund. Now, for the people who are listening in and who are not very used to these kind of terminology of multi-cap and mid-cap, so let me tell you what happens is there are some companies in the stock market which are the large companies, the giant companies, you see, which are the largest in terms of the shareholding value that they have in the stock market or the weight that they have in the stock market. So those are known as large capitalization companies or large caps for short. Then there are the mid caps who might become large caps in future. So they are somewhere in the middle of the stock market in terms of a pyramid, if you can imagine. And then there are small caps, which are much smaller, but small caps also it's a decent sized company. It's not really a company which has got 5 crores or 10 crores market capitalization. Still a significantly large number. And then you have international. So here is one fund that pretty much does everything. So there must have been something, Raj, that Parag Parikh Mutual Fund must have thought, or there must have been some ethos of why have one fund and which pretty much solves everything. So you get to invest in the best large caps, the best mid caps, small caps, and international investing. So you've got like a whole mix of it. Is that why you had one fund? Or what was the ethos, philosophy, reasoning behind creating just one investment solution for the investor?
So we like to call our multi-cap fund as the Swiss Army knife. So Swiss Army knife can do different things at the same time. So we want to make it less confusing for the investors to choose from a different variety of funds and make it less complicated. So our founder used to always say we'll launch new schemes only when we feel that we will put our own money in those schemes, and at the same time there is some differentiation in there. So we thought that when we launched this scheme in 2013, we kept all the options open in this scheme itself. So you can call it an arbitrage scheme, you can call it a dynamic asset allocation scheme, you can call it an international equity scheme, you can call it a multi-cap fund, you can call it everything, because we have kept all the options open. So just briefly, I will tell you the asset allocation that we can do within this fund. So we can invest up to 65% in Indian equities, and the balance 35% can be in international equities, debt, or we can stay in cash up to 35%. So this gives us a variety of options to invest in, and it makes it less complicated for the investor to choose from different funds when to invest where. So that makes it a little easier for our investors.
No, that's great. Actually, I'm so glad that you mentioned that we have almost a third of the fund that can actually stay in cash. Now that's very important. So you know what that means, people, is that here is a fund that out of your 100 rupees, if the fund decides that one third of this money, which is let's say 33 or 35%, exactly like Raj said, that can be outside, which is it can just remain in cash. So if they feel that the market is very expensive, the market is very volatile, or this is not the best time to invest in a particular asset, or we are not getting these good companies to invest into, or the companies are too far expensive, etc., then we can actually hold that cash. Now that's a huge advantage, you see, to a fund manager to have that cash. So the way you said that you can actually do all sorts of things, I just wanted to very quickly ask you that today as we stand, what might be the percentage that you have in large caps and mid caps, small caps, cash, and international?
So we don't look at large, mid, and small. So briefly, we bifurcate our portfolio into Indian and international, and whatever residual is there, it's the cash position. So in India, we don't look at whether it's a large cap or a small cap before investing. So we completely look at companies on a bottoms-up basis, whether it makes sense to invest in the company, whether the company has a competitive advantage, whether the valuations are reasonable or not. So all those criteria we look at, and then we invest in the company, whether it's a large cap, mid cap, or a small cap. And then there's obviously that 30-35% allocation towards international stocks, which is majorly in the mega cap stocks. So it doesn't fall in the large cap either. It's they are all mega cap companies. So something like Amazon, Facebook, Google, all those are trillion-dollar companies. So yeah, that's how we are invested across. So if you want a breakup, the breakup of say 65% Indian portfolio would be roughly 35% large caps and 17-18% each in mid cap and small caps, but we don't look at it in that.
All right, no, that's great. I mean, he actually stole the thunder from me. you know, I was going to tell you that the largest holding of this particular fund is a company that most of us use like lots of times, and no rewards for guessing who that is. You access that company in your phone, you access that in your computer. No matter what you do, you can't be too far away from Google. And Google and Alphabet Incorporated, I mean, that's the number one holding of this particular fund. By the way, my team is also going to post in the comment section of the Facebook a method by which, if you like, you could just go ahead and subscribe to this fund. It's a brilliant fund. This fund is about 5,000 odd crores, and for the last 5 years, this fund has done about 14% plus in terms of returns, which in very simple terms means that in 5 years it has doubled your money. Pretty much. And if the 7-year history of this fund is that it has actually done a little better than 14%, it's done almost 17 odd percent. So that's the kind of a history that you have for this fund. It's been a reasonably consistent performer. The expense factor is much lesser than the peers that you have. So that link that you see in your little comment box or little in the history or the thread of the chat, if you just hit onto that, you can immediately log on to Parag Parekh's website, and basically you can go ahead and you'll be able to buy this fund. If you need further assistance, my team will also post a handful of telephone numbers where you could call and you could take their assistance in terms of going through this online purchase. But we live in a digital world. It's so easy. Just go there, put in some of your basic details, follow the instructions, and within about 10 minutes you could be owning Google, you could be owning Amazon, you could be owning the best of the Indian companies. And it's a brilliant portfolio. You can even check it out on Value Research, on Money Control. You can even have a look at the portfolio. They give you like the up-to-date information as on the last day of a month. So you will know exactly where you're investing. You need further help, like I said, there are numbers on your screen. Just go there, just look in the chat box, and you can always reach out to my team, and they'll guide you with the information that you need. So Raj, coming back, you did mention that it's only domestic and it's international. Now, how do you go about researching these companies? I mean, what kind of companies are you looking for? You did mention Amazon, you did mention Google. These are trillion-dollar companies. So why I ask you this is a lot of times it's obviously a little bit of common sense also and a little bit of popular belief also that if I bought a very large stock, very expensive stock, or a very large trillion-dollar kind of a company, the growth that would have vis-a-vis if I bought a smaller company, which might become the Google of tomorrow, or which might become the Amazon of tomorrow, maybe the growth in that company is that much more faster and that much more rapid. So there must be some sort of logic on, or some sort of research that you apply to these international companies before you invest in them, And how is that different? Sort of, if you can bring that in, if you have different parameters to look at Indian stocks also. So what kind of companies, what sort of research do you look at, and is it different for Indian companies?
So qualitative factors for both Indian and international companies remain the same. So we want to partner with quality management where we can trust them, and at the same time the valuations that we pay for are also very similar. So the only thing is that the quantitative factor, so something like a return on capital or a return on equity that we look at for Indian stocks and US stocks is a little different given the interest rate differential between the two countries.
I see.
So traditionally, US interest rates have been lower than the Indian interest rates, as you would know. So the return on equity numbers and the return on capital numbers for US companies are also typically lower than the Indian companies. So those quantitative numbers are a little different while evaluating international companies, but the qualitative factors remain the same. So based on the qualitative and the quantitative criteria that we have, we filter down the companies. Then out of the whole listed universe, we come down to about 700 companies which are listed in India and globally. And in those 700 companies, what we do is we divide those 700 companies between the different analysts in our team. So the analysts are divided sectorally. So if an auto analyst is looking at Tata Motors or a Maruti Suzuki in India, he will also look at a Toyota or an Renault Nissan globally. So that's how we are divided. And if say a person is looking at a sector globally, then he will also get a competitive scenario, what is happening globally, etc., and what are the trends or the disruptions which can come in the future. So that's how we look at companies both India and global.
All right, thanks, Raj. There was a question that just popped in the meanwhile, which said that when did we start buying Amazon and Facebook? So it's been obviously a few years that you've had it. I know that you all do not churn the portfolio far too many times, and if you go and look at the graph of Alphabet, or if you look at the graph of Amazon, it's just like a 45 degrees, like an air flight. It just kind of just keeps going like that. I mean, of course, with a little bit of a bump, but it doesn't go like a yo-yo. It's pretty smooth, so it's a lovely graph to see. And I don't know if you just want, for the sake of completeness, since when have you all started buying Amazon? Is it right from the beginning, or is it recently?
Yeah, I would just like to tell that we were the first ones to actually start investing abroad. So even before we started our mutual fund, when we had our PMS, we used to advise clients on the international stocks that they can own. So post global financial crisis, what we did was that US stocks became very attractive. So we told clients that you can invest globally as well through the LRS route, and we advised them on that. So Google has been a part since 2009.
Wow.
So, and for our mutual fund, the long term equity fund, it's been there since inception. So, since 2013, it has been there in the portfolio. Amazon, we were a little late on that. So, we had been tracking the company, but on the valuation side, we were not too comfortable, or we did not understand the valuations much earlier. But after that, when we started looking at the cloud computing business of the, both Amazon, Google, and Microsoft, we became more comfortable, and we invested about 2 years back.
All right. Okay. Fabulous. Thank you. So just for your, for the sake of all the audience, the ROE factor, that's very interesting that Raj mentioned. So what ROE stands for is return on equity. Very simply put, what that means is that if the company has 100 rupees, or why even the company, let's talk about you and me. So if we have 100 rupees, and if we generate, a positive cash flow of, let's say, the business, we do our business regularly, and we generate about 30% cash flow, which basically comes in positive cash flow or profit, if you like. Okay, so as we understand, that's the net profit after tax and everything else. So return on equity is over a period of time, from that 100 rupees, from the 30 rupees of profit, we would have added some money to our balance sheet, and we would have reinvested that money. Now, going forward on a year-on-year basis, the profit that we are basically having versus the amount of money that we've put in the company is, very simply put, or very basically put, the return on equity. Raj can correct me if I'm wrong somewhere. But having said that, so this return on equity is a great tool for us to understand how is this company managing the money that they have, or what is the money that they have, by the way. The money that they have is the share capital, which is nothing but the promoter's capital and also our capital. Now, if we had subscribed at the time of the IPO, we would be part of the initial capital. But today, if you are buying the shares even from the secondary market, you are buying the stock from a particular existing investor, and he's selling his stock to you, right? So in some sense, you have also contributed a small amount of money to the capital of the company. So if a company does produce a good ROE, return on equity, then that becomes a good parameter to identify that we can consider investment in this company. Now, in the US market, because the interest rate is much lower than India, so India is about, as you know, we are at about 6-7%. The US market is much lower than that, somewhere in the range of about 1-2%. So therefore, that return on equity factor for US companies is a little lower, but that still does not take away the fact that Google and Amazon have done some fabulous performance, and they've delivered some astonishing returns. Last 6 months, this fund has done almost about 40% returns. But that's pretty much the story. There's nothing extraordinary. That's pretty much the story of most mutual funds, because in March, as you know, March of 2020, we went down to almost like a bottom of sorts, and from there everything has bounced back. So obviously the last 6 months, the last 8 months return would look exceptional for most of the investments that we have in the mutual fund space, or even in the direct equity stock space that we have, right? Now, Raj, I want to ask you one very, again, another fundamental question. So when we talk about international investing, we only look at America. And we only talk about the Google and Amazon, the Microsoft, because even as an individual investor, if I went ahead and I invested somewhere, if I opened my account, which is today possible, it's not very complicated. And there are most of the large banks and most of the large broking houses are giving us this window and this facility. We would also buy these. But is US market the only place of opportunity? Or there are other places also that you look at? And if yes, I mean, do you have such stocks in your portfolio? I mean, are you looking at, should we also look at, I mean, the global economy, I mean, in different parts of the world, different countries, and invest there, versus only look at America because maybe America is safest, best, good management, good practices, governance, so on and so forth?
So definitely you need to look at the overall world economy and the world market cap. The only reason why we prefer to invest in US listed companies is that you have only a dollar exposure, which you can manage the currency. Other than that, if you look at the companies that we invest in, they are actually present globally. The business of the companies come from all the countries, even apart from US. So US would obviously contribute a major proportion of their revenues, but they get their revenues from countries like India, Africa, Asia, Japan, or Europe, or any other developed country as well. So though the listing country would be US, but they would be getting their revenues from all over the world. Even if you look at some of the Indian companies, so something like a Tata Motors, majority of the revenues come from Jaguar and Land Rover, which is basically business which is situated abroad, and then they remit Indian rupees here. So if you look at most of the companies, they are global, truly global in nature, and you need to look at the global economy overall, where you can look at companies or multinational companies which are present across the globe. So we have restricted ourselves to developed countries like North America, Western Europe, and developed part of Asia, something like Japan. The main reason being that these countries' equity markets have been, developed over the years, and the minority shareholder rights are protected here. So the laws actually protect the minority shareholders, and we don't want to go into exotic countries, something like a China or Russia or a Brazil, where you don't have the minority shareholder rights, or say some of the Chinese companies, something like Alibaba would be listed in US, but what will happen is that the holding company of Alibaba is listed in US and not Alibaba actually. So it's basically called a variable interest entity structure, where if anything happens in the subsidiary company or Alibaba, you will not be able to vote on it as a shareholder of the holding company. So these are the minor things which we look at, and we don't want to go into countries where our rights are not protected. So right now we are restricting ourselves to the developed countries.
Great, great. People, there is another very interesting angle. I was just thinking, if you do a little bit of analysis from 1947 till, let's say, 2020, because we are in 2020 today, right? So when you do an analysis of so many years, 73 years, right? You will see that when India got independence, we were about rupees 1 to the dollar, right? Over a period of time, we have gradually depreciated. I mentioned to you a while ago that when the stock markets 12 years ago were at its last major high, major rally in 2008 January, the US dollar exchange rate to the Indian rupee was about 40, and today we're about 75. So I want you to think about another interesting logic here. So if you invested a part of your money into another country, basically buying shares of another country. Obviously, when you give money to Parak Mutual Fund, or for that matter, any fund that does international investing or any channel, you would convert your Indian rupees first into dollars if you were to buy it yourself. You give it to Parak, obviously you're giving in Indian rupees. You're buying this thing in Indian rupees. they have to buy these stocks obviously in US dollars. So then that becomes a dollar based or dollar kind of an investment. So think about it. If the Indian rupee keeps depreciating over a period of time, which it will, because if we have to grow, and if our exports have to become competitive, and like Raj mentioned a while ago, I was also thinking about it, just the way Amazon as a global company gets its revenues from everywhere in the world. In the same way, Infosys or Tata Motors, like Raj mentioned, are companies, Indian companies, which get a lot of their revenue from the rest of the world, and that money flows to India. So in that sense, if we have to become more and more competitive, if we have to sell our products and services to countries and companies internationally, what would happen is that even if the dollar kept depreciating, and if, God forbid, if your markets didn't do too much, or if the stock market did not do so much for you, but the rupee depreciated. So in Indian rupee terms, you might, it's not a perfect way to understand the hedge, but in Indian rupee terms, you'll still be better off because today you're probably exchanging your rupees at 75, 76 rupees. And then at some point of time, maybe 10 years down the line, if the rupee is at about 85 or 95 or, who knows where, uh, in 40 years we've become double, so we don't know where we are going to be in the next 10 or 15 years. So in that sense, 10 years rupee doubled. Another 10 years, if we go from, let's say, 75 to maybe, I don't know, I don't want to hazard a guess and say 150 or let's say even 110, but then what that means is that if you're saving for your children, if you're saving for sending your students, sending your children abroad for education, if you're doing anything like that, which a lot of people do, or if you yourself want to migrate or you want to have another option of another country, it's a pretty good idea to have some international investments, because then these investments are in dollars, and dollars obviously being the strongest currency or the world reserve currency. I think there is a very, very strong case to be in dollars. You know, Having said all this, Raj, I want to come to this basic point about what's happening in the markets right now. Everybody's been thinking that earnings are down worldwide, okay? Not really in India, but GDP basically is the total money that the country earns, right? So just to clarify what GDP means to everybody is that if I'm earning 100 rupees in my company, then that is the revenue of my company. If you add all the companies of India together, all the companies who manufacture and produce services, if you put all that together and what the government does, everything, that's the revenue or the total revenue of the government, which is known as the GDP in very simple sense. So what we are saying today is that the GDP is going to fall, or when we hear reports like the GDP has contracted by the 20-25% that we saw a while ago, we will only know as we move along quarter after quarter. uh, what has happened is, with the GDP goes down means revenue is going down, right? So if the revenue is going down, that means profits are also going down for people. And if the profits are going down, then how is the share price going up and how is the share market moving up? So a lot of times what we are told is that there is a rush of liquidity. There's like a flood, there's a tsunami, not a flood. There is a tsunami of liquidity which is sort of coming all across the world markets, not only Indian market, but it's sort of overflowing in all markets of the world. And because of this huge amount of capital flows or liquidity flows, as they call, uh, stock markets are rallying and they are kind of disconnected with reality. So Raj, what I want to have you address is where is this sort of liquidity coming from? Is it likely to continue? Will it suddenly just disappear one day? Because somebody has to pay back, right? I mean, today, if the US government is like, see, our government cannot do that, we know that, but the US government is actually taking money and putting into the bank accounts of various people across their country, right? I mean, literally, people are every month getting, or every week, whatever that is, they're getting money in their bank accounts, right, for sustenance, for living, and that's like a stimulus that the US government is giving to its people. And of course institutions are getting it, banks are getting it, so there's like a huge amount of money. Where will the money go? It can't go to gold, it can't go to real estate, so obviously it can't go to the bond market because the money is made in stock market, so it will obviously go into the stock market all the time, right? So having said that, when it goes into the stock market, right, what then happens is that they will flood the world markets. So will it suddenly disappear? Are we going to have some major risk on the liquidity factor? Where is it coming from? Where will it continue? Will it dry off? Because if it dries off, we are going to be in a very, very serious situation. Profits down, market up, we might crash very badly. So this is like a fear that a lot of people have. So if you can address that a little bit.
Yeah, so I'll just start with the topic which you touched upon earlier. So you said that most of the companies' profits and revenues will be down this year. So if you typically value a company using a DCF or a discounted cash flow method, you typically discount the cash flows of the company for the next 20, 25 years, and then you put a terminal value to it. So the first year's or the next year's profit would have the least, proportion in the company's valuation, whereas the later year's cash flows and the terminal value will have a major proportion in the company's valuation. So this year or the next year's profits would not have a huge impact on the valuation that you would typically pay for a company, and that's why you saw this huge rebound in May and June. So that's the basic thesis why markets rebounded. On the liquidity and the interest rate, so what has happened is that globally, if you see, about 60% of the bonds that are trading are below 1% kind of interest rates, and about 20% of them are in the negative territory. So what has happened is that almost all the reserve banks across the globe are have been printing money. So this has been happening since the global financial crisis. They tried to unwind this sometime in 2016-17, and they tried to unwind this a little bit, but they were not successful in that. And then again, this COVID hit, and they started printing money again. So this is something, due to this, liquidity has been flush in the global markets, and given the interest rates where they are, people are finding less and less opportunities elsewhere apart from equities, and that's why the equity valuations have been up. Going ahead, I don't see this vanishing on any particular day. One day you wake up and all the liquidity will vanish or something like that. It will be a slow unwind. It will be a very, very slow unwind, and when and where it will happen, it is very difficult to tell right now. It will happen definitely sometime, but when will it happen is a question mark. So I don't see it coming in the near future, because globally the central banks don't have capacity right now to unwind. Most of the governments are running a fiscal deficit, and they don't have capacity to unwind this right now. So yes, liquidity has been a flush in the market. At the same time, the interest rates have been so low that people are not finding opportunities. So equity markets valuations will be elevated for some time in the near future.
I see, I see. So that means the liquidity is going to continue. Suddenly it won't disappear. But this brings us to a very interesting point. You see, when you have so much of liquidity, when you have people constantly investing, let's say from your fund point of view, right? We're putting in money. Now you're going to buy it at the current exchange rate. In future, what will happen is that the exchange rate obviously is going to be against us. We're a developing country. We will depreciate for sure. I mean, it's not going to be that we'll appreciate unless something goes wrong with the US dollar. Only then we'll appreciate. Otherwise, most of the times, Indian rupee will keep depreciating. So there is a currency risk also that in some sense happens, right? So do you have some sort of a hedge mechanism that you put in? And there was also a question around this. But how do you guys manage this risk? So today, if you're buying something at 75, now let's say Amazon, for example, I'm just using a name just for the sake of an example, that goes up 30%, over let's say about a 3-year period, just as an example. The valuation of Amazon moves up 30%. Now, in the next 3 years, what might happen is the rupee depreciates by that much. So what will happen is today in dollars, we've made money. But what is happening at the same time is that because of the Indian rupee depreciating, you're not really seeing that impact, because the moment you convert that back to Indian rupees, what will happen is I mean, how would you manage this currency risk? And it could go against us quite badly, right?
So yeah, as you said, traditionally the Indian rupee has depreciated by around 4 to 5% every year over the past few years. So what we do in our fund is that, say if we are buying dollars today at 75, we'll hedge it by selling currency futures on the exchange on the same day at the same minute. We'll sell those amount of dollars in the future market. So
Okay.
say basically we are buying dollars at 75, at the same time selling currency futures for the next month at 75.5, for example. So
Right.
what we are doing is that we are capturing that yield or the depreciation upfront, and what we do is we get a 3 to 4% carry on this. So instead of getting an annual depreciation of 4 to 5%, at the same time the rupee and the dollar bouncing around, you get that volatile return. So what we do is we get a smoothened return of 3 to 4% over the year, and that's how we manage our currency. So yeah, that's the basic.
Oh, I see. Okay. So that means one should not worry too much about it. So even if there is depreciation because you are hedging it, you are constantly, you bought dollars, you sold a currency future. So in that sense, whatever 4% depreciation is going to happen onto the dollar asset is basically hedged because you've already got a currency future. And this is pretty much a standard industry practice, or is it something unique that y'all are doing? Typically exporters would do this kind of stuff, or importers would do this. I don't know. So is it very unique, or is it something special, or generally industry kind of a
Yeah,
standard operating procedure?
yes, that's correct. So, as you said, exporters and importers do this. Most of the international funds that are there in the industry do not hedge the currency. Since the rupee has been depreciating against the dollar, it hasn't impacted them till now. But as and when the rupee starts appreciating against the dollar, it might impact the returns of those international funds. So this is something which is different in our fund, and we have been managing this well. So we hedge about 70 to 90% of the foreign exposure that we have. So that's the broad range that we have. So we don't go above 90% mainly because, say, if the foreign stocks appreciate by 10% tomorrow in the market, then the hedge, we might be over hedged and we might take currency exposure directly. So that's the broad range of 70 to 90% that we manage.
Correct. Okay. That's great. And, we've almost come towards the end of our, little show today. So I have this basic question which I ask all my guests who come and who represent, who are product manufacturers and who manufacture these beautiful ideas where we put in our money and things like that. So, we've been talking about restarting India. We've been talking about reset India and, all sorts of acronyms that come in from the government, come in from the private sector. A lot of us are still kind of working from home, or, we've started working from office, but everyone's, the kind of fear is gone down, but it's not eliminated. So we don't know. Suddenly the fear also spikes up. It's like the volatile index. Fear also goes up and down every now and then. So in that sense, what is your house view? What is the fund view? Should people be like really worried? We know there are standard operating procedures. You put in 100 rupees today, do an STP, do a systematic transfer plan, move the money into the fund. But the question is, should we do it 1 year? Should we do it 3 years? Should we sort of wait? And or should we just go in and attack because nothing's wrong and everything's back? And like you mentioned, the discounted cash flow of 25 years is already working in your favor, so everything should be good. So what kind of a strategy would you tell our investors? One, and the second thing is what is the view on the reset of India, or for that matter, the reset of Indian companies? How is the future going to look like? And I know it's a little bit of a crystal ball gazing I'm asking you to do, but there's always a view that everyone has. It could be personal, it could be a fund view, whatever you think best suited to answer here.
Yes, so whatever I am saying right now is my personal view. It's not the fund view.
Right.
Basically, what I see over the next few years is that we'll see some disruptions in some of the sectors. So something like auto or power, or there will be some sectors where we see disruption. At the same time, technology is something which will come to the forefront, mainly because we have leapfrogged about 2 3 years in these last 6 months time post COVID. So everything is happening virtually, just like your forum, which is happening virtually, which used to happen personally. So yeah, we have leapfrogged technology to some extent, and there will be some sectors which will do well. At the same time, what has happened is that due to the disruptions in after COVID, there has been some supply chain issues in the small and mid cap companies, and or MSMEs for that matter. So what has happened is that the larger players in each of the industries have become more stronger, and we'll see market shares in almost all the industries moving towards those top 4 5 players. So the strong will become stronger is what my thesis is over the next few years, mainly because of the disruptions that we have seen in the last 3 4 years. So starting from demonetization to GST to COVID, it has been really hard for the smaller companies, for MSMEs, and the small and mid cap companies. So yeah, that's the main thing.
So that's a very, very interesting observation there. The strong will become stronger, and the weak will have to either reinvent their model, or they'll have to change their business strategy. They will have to rediscover themselves. And there's a lot of that which is going to happen in that space of smaller companies and smaller businesses. So if you're working with a company who's small or who's medium sized, maybe you also want to think about your own personal strategy. I think this last 6 months has been a time where a lot of people have built up a lot of new skills, people have ventured into new activities, there are new business models that are coming up. And from whatever I understand with my work with some scientists and people who are in the space of climate and science and technology and all of that, I know that the world is going to be very, very different, and it's not going to be the same normal. So do not think that by February it'll be the same or by June it'll be the same. A lot of things are going to change, and like they say, the faster you are, the better you will be able to adapt. So adaptation is like one key word, and that is something that we're learning from these companies also. And like Raj said, the stronger will become stronger. So if you're not strong enough, you need to become strong. And that's one of the messages I want to give you, and I want to leave you with that. Once again, thank you, Raj. Thank you, everyone who's watching this live telecast. If you have any further continual questions on this, do put it on the chat, and we will try our best to sort of answer that. Do put it on the Facebook. Do share this page. We do these sessions very, very regularly. You can also catch them on the YouTube if you feel that's a comfortable medium for you to kind of listen to. Do share it. And we'll come back to you very soon with yet another forum and yet another investment idea and yet another opportunity. And for this particular opportunity, like I mentioned, there is a link there where you can directly go ahead and make your purchases, and you can straight away, like I said, start owning Alphabet, start owning Google, start owning Amazon, start owning some of the strongest Indian companies which are going to become stronger in the next 10 years. So with that, Raj, thank you very much. Wonderful to see you. Lovely to have you on the show, and we hope to see you soon again. And if there's any final words that you'd like to tell our viewers, do so. Otherwise, thank you so much.
No, thanks for having me. That's it. Thanks.
Thank you, Raj. Thank you, viewers. Thank you, Transcend team. Wonderful to have you there. And we'll catch up with you once again at another episode of the Multimillionaire Forum. So thank you and have a great evening. Bye-bye.